everybody, and today we'll talk about types of day trading. Day traders looking to maximize intraday profits often use one or multiply of following day trading strategies. Once you have mastered some of the techniques, developed your own personal trading styles, and determined what your end goals are, you can use a series of strategies to help you in your quest for profits. First one would supposed to be a trend trading is when you look at longer time frame chart and determine an overall trend. Once the overall trend is established, you move to a smaller time frame chart and look for trading opportunities in the direction of that trend. Using indicators of the shorter time frame chart will give you an idea of when to time your entries. For example, if of this style of trading, see Pip's surfer word we note Kawabunga system. First, determine what the overall trend is by looking at longer time frame. Once you're determined the overall trend, you can move to a smaller time frame and look for entries in the same direction. The next one, Countertrend daily trading, is similar to trend trading, except that once you determine your overall trend, you look for trades in the opposite direction. The idea is to find the end of the trend and get in early when the trend reverses. This is a little bit riskier, but can have huge payoffs. In this example, we see that there was a long and exhausted downtrend of the first 4-hour chart. This gives us an identification that the market may be ready for reversal. Since our thinking is counter-trend, we would look for trades in the opposite direction of the overall trend on a smaller time frame, such as 15-minute chart. Traders who use this strategy need to be quick to spot the end of the trend in order to open a position on the optimal entry point. This strategy is fighting trend and can work against traders at times. Once again, remember that going opposite of the trend is very risky, but if timed correctly, it can have huge rewards. Counter-trend trading favors those who know recent price action really well and so know when to bet against it. Next one, range trading, sometimes referred to as channel trading, is a day trading strategy that starts with an understanding of the recent price action. A trader will inspect chart patterns to identify typical highs and lows during the day while keeping a close eye on the difference between these points. For example, if the price has been rising off a support level or falling off a resistance level, then a trader might choose to buy or to sell based on their perception of the market's direction. This is known as a trading in a range, where each time price hits a height, it falls back to the low, and vice versa. A day trader who is using this strategy, who is looking to go long with the buy around the low price and sell at the high price. A day trader who is using this strategy, who is looking to go short with the sell around the high price and buy at the low price. Most range traders will use stop losses and limit orders to keep their trading in the line with that they perceive to be happening in the market. A stop loss order is the point at which a position is automatically closed out of the price if the security drops below the trader's entry point. A limit order is an automatic closing of a position at the point where the trader perceived a profitable run could end. Range trading requires enough volatility to keep the price moving over the duration of the day, but not so much volatility that the price breaks out of the range and starts a new trend. But if the price does break out, there is a strategy for that as well. Breakout trading is when you look at the range a pair has made during a certain hours of the day and then placing orders in other side, hoping to catch a breakout in the direction. This is particularly effective when a pair has been a tight range because it's usually an indicator that the instrument is about to make a big move. Your goal here is to set yourself up so that the move takes place. You are ready to catch the wave. In breakout trading, you determine a range where support and resistance have been holding strongly. Once you do, you can set entry points above and below your breakout levels. As a rule of thumb, you want to target the same amount of pips that makes your determined range.
And the last one for today, that is a news trading, one of the most traditional, predominantly short-term focused trading strategies used by day traders. Someone who is in news trading players less attention to chart and technical analysis. They wait for information to be realized that they believe will drive prices in one direction or the other. This information could be a report releasing economic data such as unemployment, interest rates, or inflation, or simply breaking news or random presidential tweets. So do well with the news trading. Day trades tend to have a solid understanding of the markets in which they are trading. To do well, these trading day traders tend to have a solid understanding of the markets in which they are trading. They develop the insights to determine how the news will be received by the markets in a question in terms of the extent of which its price will be affected. They will be alert to various different news sources at the same time and know when to enter the market. The drawback of news trading is that events that cause substantial movements in the price are usually rare. More often than not, the expectation of such events are factored into the price in the run-up of the announcement. To summarize, we have checked 5 possible types of day trading that you almost can use in your strategy, in your day trading, in your practice. I hope this information was useful for you. Thank you so much for your attention. Wish you profit trading, stay wealth, and see you soon.